Over 150 companies reported this week, and quite a number of important ones. Looks like the anxiety that gripped the markets at the start of earnings season is gone. Markets are now up double digits this year. Chipotle, this was once the hottest of all restaurant stocks. No longer. There was quite a bit of news in the payment space, and some of it was pretty bad. Take Fiserv. The company reported terrible numbers. Meta, Google, and Microsoft all reported Wednesday night. All three beat on revenue and earnings per share and did so impressively. I just want to first point out that anyone thinking that the AI story is going to end anytime soon was disabused of that with these results. Hi, this is Steve Eisman, and welcome to another episode of the Weekly Wrap. This is for the week ending October 31, 2025. So happy Halloween. The week began with what looked like a trade deal between the United States and China, or at least the outlines of a deal. On that news, on Monday, markets reached all-time highs. Looks like the anxiety that gripped the markets at the start of earnings season is gone. Markets are now up double digits this year. It's been quite a year. On Thursday, however, the actual US-China deal came out, and all that happened was a one-year truce. On Wednesday, as expected, the Federal Reserve cut rates 25 basis points for the second time this year. And at his press conference, Powell warned that a third rate cut 6 weeks from now might not occur. The market did not like that. Why? Well, two reasons. First, because the market always likes cheap money, because that fuels the stock market. And second, rate cuts are viewed as economically expansionary, which the markets also like. As the market went up this week, Nvidia reached $5 trillion in market cap, and Apple and Microsoft breached the $4 trillion barrier. By the way, in comparison, in Europe, the stock with the largest market cap in Europe is not even at $500 billion. This is just more evidence of what I've been saying that shows how dynamic the US economy has become and how sclerotic Europe is. Now, before we get to earnings, and it was a big week for earnings, I want to focus on some AI announcements. A few weeks ago, Oracle announced a big deal with ChatGPT, and the stock soared. Soon thereafter, AMD announced a deal with ChatGPT, and the stock soared. On Tuesday of this week, PayPal announced that it will be added as a payment engine for ChatGPT. The stock soared. And also on Tuesday, Nvidia announced it was taking a $1 billion stake in Nokia. And together, they will be developing a new 6G cellular network to run on Nvidia chips. Nokia stock soared. Now on Monday, Qualcomm announced a chip deal with Humane, the Saudi Arabian AI startup that is building data centers in Saudi Arabia. So, you guessed it, Qualcomm stock soared. Although here, with respect to Qualcomm, there may be a bit less than meets the eye. Humane has also announced deals with NVIDIA and AMD. So Humane is, I think, hedging its bets on chip supply by striking a deal with anyone it can. Now that's great for Humane, but no guarantee in the end as to how many chips it will actually eventually buy from Qualcomm. Just notice that the deals Humane struck with NVIDIA and AMD are more than twice the capacity than the deal it just struck with Qualcomm. Just thought I'd flag this because in the end, the details do matter. But right now, any announcement is greeted with joy. By the way, if anyone is listening, I am happy to become the spokesperson for anyone in AI. Maybe my stock will soar. In some not such nice news, it looks like the negative impact that AI will have on employment or unemployment has begun. Amazon announced that it will be laying off 14,000 corporate workers as it invests more in AI. And now back to earnings. Over 150 companies reported this week, and quite a number of important ones. That number is pretty insane. Couldn't they spread it out a bit better? Anyway, like last week, I'm going to divide earnings reports between AI and everything else. On the AI front, the big three, Meta, Google, and Microsoft, all reported Wednesday night. And before we get to the results, I just want to first point out that anyone thinking that the AI story is going to end anytime soon was disabused of that with these results. All three upped their 2025 CapEx. Meta is spending in the low 70 billion this year. Microsoft has spent 80 billion for its fiscal 2025. It's now in fiscal 2026. And Google is at 90 plus billion for 2025. So everyone should expect NVIDIA to report great numbers when it reports. Now, with respect to earnings, all three, Google, Meta, and Microsoft, beat on revenue and earnings per share and did so impressively. Results were objectively strong pretty much across the board for all three, and yet, after hours Wednesday night, Meta was down 7%, Google was up almost 7%, and Microsoft was down 4%. And while it's always difficult to explain market reactions, here I'm going to try to explain it anyway because I think the press got it wrong. Now let's get Microsoft out of the way first. The company reported $77.7 billion in total revenue versus the consensus of $75.4. Cloud revenue growth was strong at 39% growth. That's unbelievably impressive. So why was the stock down after hours? I'm not 100% sure. It could be because on the call, the CFO said that CapEx spending would be higher than previously forecast for this current fiscal year. Or perhaps because the company reported a loss under the equity accounting method from its ChatGPT investment. It reported a loss because under the equity method, it has to report its percentage share of ChatGPT's negative net income. So maybe some nitpickers focused on that. Meta and Google also reported great numbers. So why was Meta down and Google up? Now, the press focused on a one-time tax hit to Meta, but I don't think that's it at all. All three companies, Google, Microsoft, and Meta, as I pointed out, are spending huge amounts on CapEx because of AI. But Meta is actually a much smaller company than Google and Microsoft. Meta's market cap is 1.7 trillion, Google's is 3.4 trillion, and Microsoft is 4 trillion. Also, Google and Microsoft have enormous cloud businesses, and so their AI-related CapEx is not just to create new products, but to also provide actual cloud services to customers who are demanding them now. The cloud AI-related investments for Microsoft and Google are generating revenue now. Now, Meta has no cloud business, so its AI spending is solely to create new products. So my conclusion is generating a good return on invested capital will be easier for Microsoft and Google than Meta. Now, remember that all three companies are spending this CapEx out of their own cash flow. And again, it is easier for Microsoft and Google to bear the burden of these enormous CapEx expenditures, which are going even higher next year than Meta. And how do I know this? Just look at Meta's balance sheet. For the September quarter, which just passed, Meta's cash and cash equivalents equaled $44.4 billion, down from $77.8 billion at year-end 2024, which is a decline of 43%. Now compare that to Google, which had cash and cash equivalents of $98.5 billion, which is up from $96 billion at year-end 2024, and Microsoft's cash and cash equivalents, which were at $102 billion, which is also an increase versus December of last year. All this CapEx is expensive, but clearly Google and Microsoft are bearing this burden more easily than Meta. And that's why I think Meta's stock was down after hours on Wednesday. Thursday night, Amazon also had a very good quarter. Earnings per share was $1.97 versus $1.57 estimated. Total revenue beat, Amazon Web Services revenue beat, and Amazon advertising revenue beat. All in all, a very good showing from Amazon. Now, Amazon has lagged the market badly this year, and it is the worst performer amongst the Mag 7. Up prior to today, only 1% for the year. But on these really good numbers, the stock rose more than 10% after hours. And just to make life even busier, Thursday night Apple also reported. Now, several months ago, Apple's stock was down double digits for the year. But since then, it has staged an enormous rally. The Google antitrust verdict meant that Google can still pay Apple $20 billion per year, which is a 100% margin business for Apple. Also, the new iPhone 17 has been beating sales expectations. So from down double digits, Apple has climbed to being up 11% for the year. Still, Apple does not have an AI strategy, and the market still wants to see that. Apple reported Thursday night. Earnings per share beat at $1.85 versus the $1.77 estimate. Revenue beat the consensus by a bit. iPhone revenue missed by a touch, but services revenue beat. More importantly, the company expects for the December quarter revenue to grow 10 to 12% and iPhone sales to grow double digits, which would be the strongest iPhone results in the company's history. The stock was up nicely after hours. Now let's move on from AI. Homebuilders. Last week, Pulte Home and NVR reported, and both results were not good. This week, the country's largest home builder, DHI, reported, and same bad results. Revenue was down 3% year over year, earnings per share missed expectations by 8%, and earnings per share was down a whopping 22% versus last year. The reason the company's earnings are being hurt is that it and other home builders have had to increase incentives to get consumers to buy homes, and that hurts margins. Nothing good to report here. UnitedHealthcare. The stock has had a big rally off of the bottom of around 270 in July. The company reported Tuesday morning. It's clear to me that many issues remain. Now, on the positive side, revenue was up 12% versus last year, but the company's operating margin was a pretty pathetic 2.1% versus 5.6% last year. United's two major businesses are UnitedHealthcare, the traditional health insurance business, and Optum, the division dedicated largely to providing medical services for Medicare. Optum has been the growth engine, but right now, the insurance division seems to have stabilized its margins, which is to be expected. Health insurance is a very short-tailed business, and so it can be repriced fairly quickly for elevated healthcare costs. And that is what United is doing, and the market likes that. However, Optum is a government reimbursement problem, and it remains a problem. Optum's overall margin was 3.6%, but the key division within Optum, Optum Health, which provides medical services directly to Medicare patients, had a margin of only 1% versus 8.3% last year. No signs of improvement. The market seems to assume that United's problems are easily fixable, and the traditional medical insurance division probably is, but the Optum government reimbursement problem remains with no signs, in my view, of getting better. Moving on to payments. There was quite a bit of news in the payment space, and some of it was pretty bad. Now, on the positive side, from a macro perspective, Visa's results show that the consumer is still spending. Visa has a fairly simple model. It makes around 15 basis points per transaction. That's about it. But it does make more on cross-border transactions. But generally speaking, revenue goes up or down more or less with payment volume. This quarter, earnings beat, revenue was up 12%, and total payment volume was up 9%, which is actually quite good. I've said it before, and I'll say it again. The payment space is incredibly dynamic and changes all the time. It changes so rapidly that it's hard to invest in the space at all, outside of Visa and MasterCard, which continue to dominate with their incredible duopolistic franchises. Everywhere else in payments can be really dangerous because things change so quickly. Take Fiserv, a once dominant player in the space, but a company that has been losing market share to the newcomers for years. On Wednesday, the company reported terrible numbers. They missed every metric by a mile. Senior management was fired. And on the call, new management stated that the company has been masking its problems for quite some time, and the new management took long-term guidance prospects way down. This is a very troubled company, and the stock went down over 40% on Wednesday alone, and is down over 60% this year. Ouch. Residential solar space. Residential solar was a hot space during COVID, with rates at zero and with tax incentives from the federal government. Consumers were incentivized to put a $30,000 solar system on their roofs. Enphase, which manufactures inverters and batteries, was the bellwether of the group. The stock reached $340 at the end of 2022 and has gone straight down since then, reaching, get this, $32 now, and was down 11% on Wednesday alone when it reported. Why? Well, the company's results were fine. It had $410 million in revenue, the most in 2 years. But federal tax incentives are going away. And on the call, management believes that its revenue will bottom in the first quarter of 26 at $250 million, which is quite a lot lower than the $410 million it just reported. That's why the stock got smoked on Wednesday. Residential solar stocks may one day make a comeback, but with an administration that does not favor solar, that time is not now. Cellular. All three cellular companies have reported. AT&T numbers were good, T-Mobile's numbers were great, so it was clear that both AT&T and T-Mobile are taking market share from poor Verizon. Now you may recall that a few weeks ago, Verizon fired its CEO and replaced him suddenly with Dan Schulman, the former CEO of PayPal, where, I might add, he did not do such a great job. Everyone expected Verizon's numbers to be bad, and they were bad. But on the day they reported, which was Wednesday, T-Mobile and AT&T went down. Why? I think the Verizon numbers were bad enough that investors are worried that Verizon may try to cut prices to stem the market share bleeding. We shall have to see. Moving on. Chipotle. The motto here is peacock today, feather duster tomorrow. This was once the hottest of all restaurant stocks. No longer. The company reported Wednesday night. Revenue fell short of expectations, and it cut its same-store sales growth forecast for the third quarter in a row. Even worse, in February, it had been expecting fiscal 2025 same-store sales growth to be positive mid-single digits, and now expects them to be negative. It is also seeing consumers across all income cohorts visiting less frequently. And finally, on the earnings call, management discussed food inflation and that it would not be raising prices in tandem with that inflation, which of course raises the issue of future margin pressure. Shares were down more than 15% on Thursday and are down 45% for the year. The market does not forgive once great growth stories that have gone ex-growth. Moving on, Starbucks. The company is in the midst of a very difficult turnaround. It reported a small same-store sales growth this quarter, which is the first same-store sales growth of any kind in 2 years. So that's good. But it missed earnings per share expectations. It reported 52 cents versus 56 cents in expectations. The stock was up a bit on Thursday on those numbers, but is down 8% for the year. This has been a very slow turnaround story, and investors clearly want to see more. Eli Lilly. Hands down, Lilly is winning the weight loss drug wars over Novo Nordisk, and that showed this quarter. Earnings per share was a whopping $7.02 versus an expectation of only $5.69, and revenue was $17.6 billion versus an expectation of $16 billion. The stock was up nicely Thursday on the news. Finally, I just want to end by flagging one name, Carvana. This is a used car company akin to CarMax, but without the physical dealerships. There was a time where almost every hedge fund I know was short this stock. It reached a low of $3.50 in December 2022 and then proceeded to take the shorts out, reaching a high of over 400 this year. This is a very controversial and complicated name and worthy of an eventual deep dive, but not today. There are clearly problems in the entire used car space. Now, Carvana reported strong revenue, but missed earnings expectations for the first time in a long time, and margins were under some pressure. The stock was down over 10% on Thursday. And that's the wrap. This week, we dropped an interview with Andrew Sorkin, where we discussed his new book, 1929, which is all about the crash of 1929. And we also discussed parallels to today. On Monday, we will post an interview with the management of a cannabis company. Now, cannabis was once a super hot group, as everyone expected the Biden administration to legalize cannabis, which it did not. The cannabis group raised too much capital during the good times, which created overcapacity, and because of the lack of regulatory change, the group has been left for dead for years. My interest got piqued for the first time ever, a bit over a month ago, when President Trump posted positive comments on the medicinal value of cannabis twice on Truth Social. Maybe it's time to look at this sector again. Hope you will tune in. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes, as well as the financial literacy masterclasses, and some other goodies as well. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.